I appreciate everybody being here. Um, we're going to talk about two really great option strategies just that can be used in all kinds of different market environments. But when we get into uncertain times, you really want to keep your risk as low as you can. But these are some strategies that you can use that will, keep your risk low, but they're also going to provide you some very big potential high returns on that risk. And they're fantastic for hedging. So I always tell my members and clients if you don't know how to hedge, you're a trading accident waiting to happen. So these are kind of the go-to strategies for what I use for hedging. When you get into a situation on any kind of option trade or any trade in general, you can hedge it. But we can really do a lot of different hedging techniques using these two strategies. So we'll talk about that quite a bit here tonight as well. So again, appreciate everybody being here, and let's get going. So the following presentation is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. I don't know if you know much about my background, but I've been actually trading options for over 30 years. And I started out on the trading side of oil, trading cargoes of crude oil, started back in the 80s. And long story short, ended up with a company called Transworld Oil and ran their international trading desk for 10 years out of Bermuda. So Transworld was one of the largest oil trading companies in the world. And so we were involved in a lot of different oil markets, plus, all the different commodity markets. So it was a great experience, but that's where I first started trading options back about 1987. So I've been pretty passionate about the option side of things ever since. And so hopefully I can pass on a few things to everybody here tonight. Now, when I look at trading, to me, the secret to trading profits really come down to three things: direction, timing, and then good risk management. And we can do that through, options and the various different option strategies. So, when we're trading options, they have so many more advantages than just trading outright stocks. But as you probably know, they can be a bit more complicated as well. But once you understand the benefits and the advantages that you're going to get from using options and option spreads, you're really never going to look back. You're going to want to just use options. So when used correctly, option spreads are going to help you to get really defined trading risks. So you can really sharpen your trading risk using different option spreads. It's going to lower your capital at risk. It's going to provide you greater trading leverage, and as you'll see here, tonight, it's going to, provide you some unmatched hedging advantages as well. So, what if you had a trading strategy that could, even turn around a losing trade and maybe even turn it into a winner? And what if this same strategy could capitalize on the two main option pricing components, time decay and volatility, more than any other method? So, would this be worth your time to learn it? Now, over my 30 plus years of trading options, I've found that the most valuable go-to option strategies that can literally help any trader or investor out there more than any other strategies are to understand and use the butterfly and long condor option spreads. So these are two really great strategies to incorporate into your trading. Now, the huge advantage of these strategies are their unique option framework that allow you to construct trades that will provide you more consistent and greater returns in any type of trading environment. And especially when we get into high volatility markets or really times of uncertainty. So there's a lot of uncertainty in this market that we're currently in. And because of the way that we can structure these trades, you're going to see that they require only a very small amount of your hard-earned capital. And that's going to really make your trading returns greater on that small capital, plus it's going to really lower your trading stress. And so for me, that's always a really win-win situation. Now, when we look at the butterflies and long condors, they're very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade the butterfly and the long condor, and you're going to be covered for both your offense or your profits and defense. Okay, so goals and protection. So that's the great thing with options. We can do so many different things, and these are two great strategies to give yourself great potential return on profit and also for hedging. Now, when we look at these two strategies, they can work no matter what the markets are doing. They can be up, down, or sideways. They can provide income from stocks that are going nowhere They're going to help you to eliminate the stress of having to be perfect on a stock's direction or overall market direction, and eliminates the time decay expense that you're going to encounter if you're just constantly buying options. So they're going to also help to take the unsettling guesswork out of your trading. They can be structured at a very, very low cost or low capital at risk, and you'll see that they can offer returns of 10 to 1 or higher. So we'll look at a lot of different examples here in a little bit. Now, they can also, the butterfly and long condor are also very flexible, as you'll see here. And once you learn the fundamental setup of how they work, then you can adapt these strategies for both of your goals and your market insights. So, they can be structured for kind of more of a delta neutral where the markets are kind of going nowhere. But to me, the real beauty and the really great part of these two strategies are to use them for your directional trading. So these can offer you either a bullish or bearish exposure to the market when you feel pretty good about a certain direction that the market may take. But the great thing is if you are wrong, the butterfly and long condor option spreads are going to help you to keep that risk very, very low, but at the same time potentially retain large potential returns. And that's a win-win. So you can get your risk low, you can hold the trade for a while because of the time component of it that we'll talk about, and they have a potential for very large payoffs on your capital at risk. Now, let's be real though, these types of spreads are not going to offer you that unlimited profit potential, but as you'll see, they're going to cost you a lot less than if you're just buying outright options such as calls, and they're an amazing risk-reward trade setup. So this means that the butterflies and long condors can significantly increase the probability of your winning trades while also reducing your risk. And that's really, really what it comes down to in trading. We want to keep our risk under control. So the longer you're in the business or game of trading, it's a business of probabilities, and we want to try to always keep that risk very, very defined and low so you can stay in the game for the long run. Now when we can here, okay. All right, so when we look at the butterfly and long condors, they're also fantastic for hedging. So when you mess something up, and we're going to have those trades that are, you think are great, and they start out great, but then all of a sudden the market goes against you. So these two strategies are the best that I've found for hedging. So when you have something that you mess up and you want to cover yourself, pronto, you can construct and either construct a butterfly or a long condor hedge around your strategy, and around your trade. And I've found no other strategy that comes close to using these two options strategies for hedging. Now, by constructing either a butterfly or long condor around your strike prices of a certain option trade that you have that's under pressure from another core trade. So let's say you do credit spreads, and probably if anybody here has done a credit spread, you've probably had the experience where you get your short strike overrun, and you turn a potentially good profit into a big loser. So this is a great strategy to use to immediately offset that kind of exposure, so they can be used to hedge credit spreads or debit spreads, whatever. And it's the best way I've found to immediately lower, neutralize, and control that risk. Now, so for example, when you're using either the butterfly or condor, what it takes advantage of, you put the butterfly or long condor around your original position that you want to hedge. And what these strategies do, they're going to take advantage of the time decay component that constructs part of the option trade. And so while you wait, a lot of times, you put a trade on, it looks great, and then all of a sudden there's a headline or something comes out, loses that momentum, stalls, and so you're not sure what to do. So you either maybe stop yourself out, or you don't get out of the trade and you lose a lot of money. But if you're able to do these two type of hedging strategies, what it does, it can buy you time. And since it also takes advantage of time decay, while you wait that trade out, and a lot of times that's all you need is just a little bit more time for that trade to stabilize, and then, it goes back in your favor. But as it's, you're buying that time, you're getting paid, because you've got that time component built into the strategy. So when it does turn around, hopefully, you remove that hedge, stick with your original trade, write it for what it's worth. So it becomes a really great trading strategy to put around a core position to buy yourself time for the trade to work out. And at the same time, it's also going to reduce your exposure as far as your downside risk. Now, when we look at the butterfly, it's basically, they're pretty simplistic actually. So here's kind of the basic butterfly. So here's like a, your capital at risk. This would be like a call credit spread. So not credit spread, but debit spread. So you're long a call here and you're short a call. All right. So in this example, your risk is your debit paid of $300. Now, if you go up and you close above your short strike here, this is like 1020, you make your max profit. But, I always teach all my clients and members that you try not to ever lose your total capital at risk, even if it's defined like this. So we can neutralize and reduce this risk quickly. All we have to do is add another spread to it, and that would be selling another credit spread or selling a credit spread against this debit spread, and that's going to reduce that cost of the trade right there. So what we could do is just add a credit spread to it. So we could sell a credit spread with the same short strike as the debit spread. In this example, bring in $200 credit. All right, so now we're short a call here, long a call. Okay, we add that to the trade. So we sold a call, bought a call here at the same short strike there of the debit spread, and we brought in $200 credit. So we just took that $300 and knocked it down by the credit received there, and now we've converted this to a balanced butterfly, and our risk has been reduced to $100. Now with this balanced butterfly, we still have potential to make even a lot greater return than we would on that original call debit spread. If it trades within this profit zone at expiration, this is where you can really get a big payoff on a very low capital at risk. So we've got a lot of different things we can do. We can, number one, you can just leave the trade on with the butterfly, see if it goes out within your profit zone, or you can leg out. You can close out the credit spread side that you put on, or you can close out the debit spread side, or you can add additional credit spreads to it to make what we call ratio butterflies and things like that. So it's just a great strategy that you can also then adjust and add to. So that's the typical balanced butterfly. Now the next one is the long condor, which is very similar to the butterfly, so I kind of group it into the same family as the butterfly family. But the great thing with the long condor, you can use calls or puts, is that it's going to separate or spread out your short strike. Your profit zone is going to be increased. So if you look in, you did a butterfly, it's great for reducing your risk, but you're going to have a tighter window that you have to thread to get that max profit. So in certain situations, the long condor is great because we can spread that strike prices that were short out, creating a bigger profit zone. So this is a great structure for reducing risk, but also giving yourself a big high return on that risk. And when I'm hedging, I usually go to the long condor first as a hedge, and then if I need to, I can drop down to convert it back to a butterfly. So just a lot of things you can do with these types of vertical spreads once you understand how they work. It's kind of like a chess game or cards or something. Once you understand the kind of the fundamentals, and there's so many different things you can do. All right, so that's the long condor. Now, the core concepts that make the butterfly and condor work really comes down to time decay and how option pricing works. So the most important option factor for profit generation when we're using the butterfly or long condor strategy comes down to understanding how option pricing works and that concept of time decay or theta and its effect or impact on the price of your options. So let's kind of take a quick review of that. Now, when we look at the option theta value, that's going to tell us how much your option price will go down over time. So that's the rate of time decay of your stock's option. And this time decay occurs because that extrinsic value or the time value of your option goes down each and every day as you get closer to expiration. And at expiration, time goes to zero. And also volatility goes to zero. So when we're doing option spreads that have a selling component to it, we are basically, in theory, we're selling time and we are also selling volatility because those are two pricing components of your option that go to zero at expiration. So we can take advantage of that, with certain types of spreads such as the butterfly and long condor, which has that selling component to the spread. So when we look at the different butterflies, here's a butterfly balance and here's a long condor. So next, let's take a look at just the simplicity and how they work and how you can really get your risk defined and very, very low. So here's an example. So this XYZ company, okay, is trading at $45, and we're looking for a directional move to the downside. So we're targeting, in this example, $43. So when you're trading, anything you're trading, you should always have a profit target established to where your price target will be for your exit. So when any trade that I put on or teach my members to, the first thing you want to do is always, before you even put the trade on, is have your targets set up. Where is this trade? Where do you think it's going to go? And that would be your profit targets and then your stop loss targets. And so what I like to use for my price targets are usually I use Fibonacci levels and then, key moving averages. All right, so in this example, there's let's say a good Fibonacci level at 43. So we're looking for a move just, down $2. So we're just going to target 43, and we're going to do this very, very low risk. So we can do this with the butterfly, and we can do it to target that 43, and that will be the body of the butterfly. So in this example, we do a put butterfly. So we buy the 44 October put here. It's going to cost $238 or $238 at a debit cost for one option contract. And then we're going to sell that 43 put against it. We're going to bring in $1.67. Then we're going to sell that 43 put again, bring in another $1.67, and then buy the 42. So if you look here, we've got a dollar wide spread width between each strike. So that creates your butterfly. So in this example, it's a very narrow butterfly, right? So we can control the risk reward of the butterfly by the width of the wingspan. So this is a very narrow one, so we're going to have super low risk on this. So if you go through the math here, you'll see that, your debit cost was that $238 for the 44 put long, and then the 42 put cost you $1.06, and then you got the credit for selling 243 puts here, all right, times 100 to make it into an option contract or spread. So the total risk on this example is $10 per spread. You do one spread, that's your maximum risk. Now your profit, you just take that middle strike, 43, and take that lower strike, less your debit cost, times 100, and that gives you your theoretical profit. So in this example, that's going to be 90 cents times 100. So $90 would be your potential profit on this butterfly example if it goes out exactly at that, body of the strike, the body of the butterfly at 43. Now, I always call this theoretical because you'll never get that exact amount because it's, you're threading that needle, but you'll get pretty close. But the big thing here, if you look at it, you're risking $10 per spread to make 90. So that's a 900% return, right? 9 to 1, risk $1 to make 9. So it's a great strategy to keep your risk super low and controlled, but it's also a great strategy because it can give you a fantastic payoff on that low capital at risk. So it's a great one when you're in a really high volatility market. You can still get the big payoff, but your risk can be super low. So here's another example. So and they're great for the ETFs, SPY, QQQ, IWM, the index options, SPX, etc. So here's an example of a butterfly on SPY, the ETF. So here is going along the 203 call, okay, and that's going to cost $3.10. So, your debit cost is $3.10, and then you're going to sell the 205 call against it, bring in $1.70. Okay, so if you look at that, that'd be a call debit spread, right? And then you're going to sell that 205 call again and buy the 207 call above it. So you just created now a balanced butterfly on this. So you're long the 203 here, short the 205 here one time, then short the 205 again, and then long that 207. So with this trade example, your total risk is a debit cost of $40. Okay, so you go through that $310 plus 70 minus, the 340. So $40 at risk. Now, if this goes out exactly at that target of 205, this would make $160 on your risk of 40. So that would be a 400% return. But, you still have a nice wide body or zone in here. So even if you miss on your max profit, you still have a really good potential profit within this profit zone, but on a very, very small amount of risk. So $40 per spread. So you do one, that's 40. If you did 10, your total risk would be 400. So that's the beauty of the strategy, because low risk but high reward. Now, let's take a look at the different types of butterflies. There are a lot of different variations to the butterfly. And so when we look at, trading, in my opinion, the goal for every trader, really you should look to select trades based on what's going to provide you the most consistent positive return with low defined risk and always, hitting or going for the home run. So in trading, you want to hit, in my opinion, you want to hit singles and doubles, and occasionally you'll hit that big, home run. So that's how you're going to stay in the game and keep your equity curve under control, so it's not going up and down crazy. So by doing these types of strategies, along with some others that you might want to do, it's going to keep your trading equity curve a lot more smooth. So one of the best ways then to achieve, selecting the right trade setups and options strategies is to actually be aware of the different strategies that are out there and available, understand how they work, and then select the one that's going to be best suited for the market environment you're trading or for your, specific trading style and your trading goals. So, everybody here tonight will have a different amount of capital to trade. So, trader one might have 100,000 he's trading, and trader two might only have 10,000. So that's going to make a big difference as to, your risk profile of how much you'll put at risk, and also time to trade. You might be able to sit and trade all day, or you might be just, more of a passive trader. But what you'll find out is that once you understand how to use the butterfly and the long condor, you can do it with any size trading account. So you can do it with a huge hedge fund with, thousands of contracts, or you can do it as a small retail trader with one contract. So it works regardless, and it works on any size. So one of the first big butterfly spreads I ever really saw was back, I set up an over-the-counter oil brokerage group for a big brokerage company. And we were doing a 25,000 contract butterfly spread on oil, on an oil contract. It was actually over counter, so it was physical oil, but it was amazing. And so it was the 25,000 contract butterfly. But the whole thing that I was aware of, this is a huge position, but when you break it down, it's a simplistic strategy that anybody can do. And now, with SPY, all the different ETFs and stuff, it's a great strategy for, all of us out there that are trading smaller accounts. Now, when we look at the butterfly strategy, I call it kind of the butterfly family. There's a very different variations. You've got the long call or put butterfly. You've got the broken wing butterfly, or sometimes referred to as a skip strike butterfly. So you can use calls or puts. You've got what I call the ratio butterfly. It's an unbalanced butterfly, wide wing butterfly, iron butterfly. And then you've got another group, hedging, okay? So there's a big part of using these strategies. The butterfly and condor are great for hedging defenses. And then we've got the long condor, which is very, very similar to the butterfly, but gives you that broader profit zone. So let's take a look at the different examples so you can get a better or more clear idea of these strategies and how they can really benefit your trading. So first we'll look at some different butterfly examples. And so first off here, again, earlier I mentioned that with the butterfly, you can adjust your risk and profit by what we call the wingspan of the butterfly. So, if you're a butterfly collector or whatever, if you use a really big wide net, it's going to be a lot easier for you to catch that butterfly, right? But if you use a small net, it's going to be a little bit harder. So when we look at butterflies, we can control our risk and our profit by the wingspan. So we can make either a really wide wingspan to really capture a bigger profit zone like this. So we'll have more risk on the table or put up, but we're going to have a bigger zone for capturing a profit. But if we want to really tighten up our risk, we can narrow that wing of the butterfly. We can narrow it really narrow, and we're going to have very little risk in the trade. But if you get the trade right, you're going to make a huge return. So I kind of call this type of strategy or a lotto trade, because you'll see, I'll show you a couple examples here where you can risk literally $10 to make several $100s. So you make potentially huge return on that small amount of risk. So we do it by the wingspan of the butterfly. All right, so let's take a look at some examples here. So we're going to look here at SPY, and this is a narrow wing butterfly. So the spread width on this example is $100. Now, in this example, it's a directional trade. So, and again, I like to use Fibonacci for my target levels and any kind of option activity, unusual activity. I use that too. So here we had a high to low, and so we have our fib levels here, 382, 50, and the 618. So we were targeting right here to this 618 retracement level that was coming in right around 273. And also there was a lot of option activity going on at this strike, so it made a really good target. So we did this with a really narrow butterfly though to keep the risk super low. So it was trading at 267 and we were targeting 273. So in this example, we were targeting 273, so that's going to be the body of the butterfly. So bought the 272 call, sold the 273, so that would be a call debit spread, and then sold the 273 again, bought the 274. So there is a bear call credit spread. So now we created this narrow wing butterfly, dollar apart. See, 3, 2, 4, 3. So spread width is $1, which is for an option contract $100 less the cost of the trade, 10 cents. So this is a super low risk trade, $10. Okay, so the potential profits, the difference between your spread width of $100 minus your cost. So the theoretical profit, if you were to get it perfect at that strike price of 273 at expiration, you'd make $90 on your risk of 10, so 900% return, or risk $1 to make 9 to 1. Now in this trade setup 2 days later, it was up $70 per spread, and look at that, 700% return. So if you look at a 700% return, your eyes are popping out, right? So this was 2 days later, it wasn't making 90, but it was making 70. So let's take a look. So here's the risk profile on that trade going out 2 days later. So the entry date was on the 14th, and on the 16th, it was trading right here at the almost the top of that butterfly. All right, the tent, we call that the tent. So it's trading right there at 273.08. So you can see the spread, the setup, it costs 10 cents to enter the trade. And then on this date, on the 16th, it was trading at 80 cents. So that's your profit of $70, 70 cents or $70 per spread on that risk of $10, 700% return. So with this one, this example had 4 contracts, and so that was over $280. So your total risk on this trade was $40, and the potential, profit, you can see where it was. So with the butterfly, again, we're taking advantage of selling time, selling volatility. We call that volatility collapse, and gives you, potentially really high return on your capital at risk. So again, when we go with the butterfly, the big advantage is if you are going into the day of expiration, time's going to go to 0, and you've sold that short, and volatility goes to 0, and you're short that. So that's one of the big advantages that we can get from the butterfly structure. So that's a narrow wing butterfly. All right, so let's take a look at a few others. So here's another butterfly trade. This is on QQQ. All right, so this is the the NASDAQ ETF. Now this is a wider wing butterfly, so we've spread the spread width on this one. We spread it out $300 wide. So with this one, these are a great way to short. In this trade environment that we've been in, it's been hard to short, right? You'll get 1 day or 2 days where it goes down and then it snaps back in your face. So if you've been trying to short, you might have lost a lot of money. But if you are using a butterfly, we can really keep our risk per trade down if we're trying to short. So this was a short trade setup that we did, and this is what we call a retracement failure. Okay, so this is a certain chart pattern I look for. So this is back on the 16th of September. And so basically the pattern is a really great pattern that I like to trade. And so you can see here the QQQ, it made those highs and it sold off real hard. And then we had the moving averages here. I like to use the moving averages for my target for retracement failure. So we sold off hard, and then see how it snaps back. And we were looking for it to snap back and fail at the moving average. Now, using our lower time frame, this is like a 4-hour time frame and a 1 hour, then we see where our target would be, where we are watching to see if it's going to fail there. And then we can look at the lower time frame to tell us if it's starting to stall. And then when it starts to stall, set up a butterfly and then target a certain spot, using Fibonacci levels or that butterfly body to target. All right, so that's kind of the concept behind that directional trade. But we wanted to keep the risk super low because, shorts are hard. So here's the trade setup using the butterfly, and we were targeting the fib level at 270. So and at this, when it was set up, it was trading at 276. So we targeted 270. Now we could have made this wider, but we kept it really narrow to keep that risk down. So we bought the 273 put, sold the 270, $3 wide. Then we sold the 270, bought the 267. So put debit spread and then a bull put credit spread. So we made this spread $300 wide. All right. So the spread width is 300. Look at the cost of the trade, 30 cents. That's the beauty. That's the thing that's amazing about the butterfly. You can get your risk so low. That's a $30 per spread risk. That's it. Boom. You mess up, you're going to lose 30 bucks. And we can even make that lower we can do adjustments. All right. Now the potential profit then is the difference between your spread width, the cost of the trade. And so theoretically, this trade at expiration, if it's going out right there, it would make $270. That's a 900% return if you look at your risk there. All right. Now 2 days later, though, we were up 216. So potential max cost $30, potential max profit 270. So that's if it hits the target, but you still have this nice wide zone in here. We widened it out. We made a bigger, net. All right. So we still had a good profit, but we didn't have to, thread that needle perfectly. So here's the profit zone here. So you can see this profit zone. You see all that black area right here? See all that black area? That's what's in the profit. That's time value component and volatility that's part of the option spread that makes up that price. Now, this purple line is where it was going out in time. So this was, right here on the 18th, but this was early in the morning. It was trading at 271. So we were looking for that target 270 and kind of overshot that. So it was trading right there at 271. So this still did pretty good when you look at the return on the risk. So this went from 30-cent debit to 95 cents. All right. So that's a $65 per spread profit, and your risk was $30. So that's 216% return. So the first thing I really look at every trade is I look at the risk first, and then I look to see, okay, if it makes my profit that target, then what's my return on my risk? So I kind of go the other way around. I look at my risk first, and then I back into what my potential return would be on that risk. Okay. So with this structure, we could put it on for 30 bucks, and I know the different profit points for the trade. I can use my analytics. And so here it was going out right there. Not bad. I mean, 65 bucks, but the return on my risk, $216, that's per spread. So you do one, you make 65, you do 10, you make 650. So, they're very scalable because these are very liquid ETF products as well. So that's another example of a kind of a wider wing butterfly. That was $300 wide. Now here's another example. This is on GLD, and that's the gold ETF. So it's a really good also a vehicle for trading and using the butterflies as well. So this spread width was $500. So widening out that net even further. Now this trade was set up. These are all also trades that were done in my alert service. These are actually trades that I send out to our alert members. All right, so in this example, this was a butterfly trade setup that we did on GLD, the gold ETF. So it had come up here to this 170 level, and then it started to stall. So we had a target based on Fibonacci to 175. So we wanted to do this as a very low risk trade because you can see it was going to stall here. We thought this was a big area of resistance. But if it broke through, we were looking for this target 175. So we did this with the butterfly, and then it did break through. You can see it spiked up real hard. So here was the trade setup. This was doing a butterfly again, targeting the target was 275. That's the body of the butterfly. So we did long the 170 call, short the 175, called debit spread, then sold the 175, bought the 180. All right, so wider, $500 wide butterfly here, bigger net. But look at the cost. The maximum risk on this trade was $89 per spread. So one spread 89. If you did 10, 890. Spread width $5 wide. Okay, 500 minus that cost. So potential theoretical profit, if it went out right there at expiration, would be 411. So we look at that to look at our risk reward first. Now, I'm never looking to make that max profit, but I know that's the potential. But look at the wide butterfly. So we've got a wide net here, wide zone to play. So in this trade, we didn't get it perfect, but we did good enough. So it went out trading right here on the 22nd. All right, this was set up on the 8th. And so this was trading right on the 22nd, was trading right here at 174.55. So it was trading there, but we're not going to get the maximum benefit until right at expiration. All right, so that sucks out the rest of the time component that's in that option spread and the volatility. So we're not going to get that except at expiration towards the very end of the day. But still, when you hit your profit target, I always teach my clients and members, take your profit, because we never know on a trade, right? It could just rocket straight up, or it could come straight down. So you take your profit when it hits your profit target. So in this example, it went from 89 cents, the spread when it was set up, to 2.99. So you look at that, that's still a fantastic profit. So it was trading at 174.55. It went to $210 per spread profit on your risk of 89. That's a 236% return. So there's not another strategy, period, in the trading world that will give you a return on your risk bigger than the butterfly. So there's not another one that can do these types of returns. So that's what really makes it an incredible, valuable option strategy to add to your trading. Now here's another one. This is going to go even wider. This is on Amazon. And this is a really interesting trade setup I'll show you. This is $1,000 wide. All right, so we're making the net really even wider. But the really other great advantage of the butterfly is that you can trade really high-priced securities and stocks, such as an Amazon. Plus, you're going to have super low risk, and you're going to have an amazing advantage because of the time, theta decay, and volatility collapse. All right, so here's the example here. This was Amazon. It kept trading down to this 200-day moving average as support. So we were looking for this trade to bounce back up and go to this fib level here to 1830. So that was the target. So we're going to set a butterfly targeting 1830. But with Amazon, and here it was trading at 1833. Here it was trading at 1700, down 1763. So if you bought 100 shares, equivalent one of option contract, you're going to be shelling out over $176,000. That's a lot of risk. So here's the really cool thing with the butterfly. So with this trade, we were targeting 1830, and it was trading at that time when it was set up at 1,782. So if you bought 100 shares here, you would be out of pocket $178,200. Now, if it went from there, 1782, and hit your target at 1830, well, you would have made $48 per share, or 2.69% return on your risk of those 100 shares. But look at this. If you did the butterfly targeting 1830 and you did it $10 wide, so you bought the 1820 call, sold the 1830, sold the 1830, bought the 1840, $1,000 wide spread right here, your risk on this trade was $80, $80 to make theoretically potentially 920. That's over 1,000% return. So in this trade here, you're risking $80 to control a trade that's worth over $178,000, and your risk is $80, and your potential return, if you hit that target 1830, would be $920, or over 1,000% return, versus this buying the stock at $178,200, and you make $48 per share, and your return is 2.69. So it's an amazing difference here. So here's your risk, here's your potential reward, but then you still have a big, wide, fat body. So this one didn't make the full max profit, but that's where you can see that you can hit the home run. So this one actually went out right here. Here's the other part of the trade, though, that's pretty amazing here, is that this was in the morning, okay? In the morning on the day of expiration, on the 6th here, this was like 9:30, 10 o'clock in the morning. The butterfly, the price of Amazon had gone to 1836. All right, so the butterfly had set up for $80 per spread, And now at that point in time, early in the morning on the day of expiration, it had moved up to $230. All right, so that's a profit of $150 per spread. So one spread, you make 150 right there. Now that's still a pretty good return. That's 187% return on that $80 of risk. But this is an amazing part. Another amazing example. Later in the day, towards the end of the day, like at 3:30, which is an hour before the close, you're going to see this trade went from 187% return and $150 profit to 4 times that. And that was basically with the price not moving much, but because of the time decay going to zero and volatility, it sucked out and gave you more profit. So here it is about 4 hours later, the same day, same trade, but based on volatility being sucked out of it. So it's trading right here at 1832. And right there, it went from $80 and right now, same day, but later in the day, now this was up $695 per spread, which would be the $614 profit. And on your risk of 80, that's a 769% return. So this went up 4 times on the profit side and return side within the same period of time, one day, about three hours later. And that's because by using this structure, you're selling time and volatility, and at the end of the day, at expiration, those two components go to zero, so you get all that profit from selling that premium. All right, so that's really another amazing part of the trade. You can see that theta has a huge positive theta there. So that's the beauty there. Now, the next trade example is what we call, I just want to show you all the variations. There are so many different things you can do once you understand the structure. And this is what we call the Batman butterfly. This was on Microsoft. And every month, you've got monthly option expiration. So what we like to do is try to do kind of trading examples or strategies where we're trying to figure out where the market will go out at expiration, and it's called pinning. So what strike will a certain security go out and settle at at the end of the day for monthly option expiration, because that's where all the institutions are trading. So there's a lot of option volume going on. So with this one, we were looking at Microsoft, and we were looking for it to go up to a certain target or down to a certain target. So we did a butterfly at each target, and that's kind of what I call the butterfly. So and these can be super cheap. So we were looking for a monthly expiration either at $200 right here or at 180 right there, and it was trading at the time right kind of in the middle. So we looked at, okay, how could we do that? And we looked at the butterfly, and we figured out, well, we could do this cheap. So let's do 2 butterflies. So this is the Batman butterfly. So we targeted up to 200, okay, right here, doing a long call butterfly. So we bought the 197.5, sold the 200, and then bought the 202.5. So $2.50 wide butterfly, targeting right there. And the cost of the trade was $17. Super low, right? One spread was $17 of risk, okay? Now, the potential return on that would be, you take your spread with the $2.50 less that cost, you could make $233. So a huge return, right? Now, the other side of it, we didn't know, so we also targeted 180. So on this one, we did a put butterfly, the 182.5, 180, 177.5, cost $15. Potential profit $235. So the cost of the trade, total cost of the trade here was $32 per spread would be the max risk. You'd lose that if it goes out in here, or if it blows through your top strike of the call side or the put side. So you'd lose if it goes out in here or it goes out there, you'd lose $32. But your return potentially, 250 minus 32 would be 218. So if it went out here, you'd make 218. If it went out there. So it gives you a lot of flexibility. Now, this wasn't perfect, but still had a great return when you look at your return on capital at risk. So this went out at a profit of $63. It was going out right there, right there, hit our target. So we went ahead and took it off. And so $63 per spread on that risk of 32 is 197% return. So you can do a lot of different things with very low capital at risk. And so it's a great strategy for any size trading account. But if you're a smaller retail trader, it's exceptionally great benefit to it. So that's just another example that I wanted to show you the versatility of the butterfly. Now the next one I'll show you is the long condor. So in this example, it's pretty cool example as well. This was structured as a kind of a hedge. All right, so the condor is similar to the butterfly, but widens out the spread. All right, so you got a bigger profit zone. So structured for giving you positive theta. So if you're in a call debit spread or put debit spread, you put that on. You'll usually end up with a negative theta value. So you can offset that with converting to condor to give your positive theta, so you're not having that theta decay. It's going to lower your capital at risk, and it's going to give you a huge return on that risk, and perfect for hedging. So when you're trading, we always look to trade. We have targets. So always before you put a trade on, you want to think like a chess player, couple steps, couple moves ahead. So if you have a trade on, it looks good. Where do you think it's going to go? And if it hits that target, is there anything else you can do to that trade to enhance the profit, to increase your profit? So a lot of times you can increase your profit on long trades. If you're long a put debit spread, long call spread, whatever, you can enhance that return by selling a credit spread against it. And that's going to lower your risk, add additional profit, and also reduce your theta. All right, so a long condor here, we can use calls or puts, which is the beauty of it. So you could do a call condor here, all right? Or we could do a put condor. We could be long a put, short a put, so put debit spread, then etc. So the thing I love about the condor, either way we're using it, is that in this example I'm going to show you here, we started out long a put debit spread, okay? Now we were long a put debit spread looking for the market go down. When it hit our target, we were thinking a couple steps ahead. Okay, if it hits our target, can we take the trade risk here off the table, reduce it to zero? And if it gets here, we could. So then when it got to this certain point here, we were able to sell a bull put credit spread, bring in the credit to offset the debit spread cost here, making this zero cost or free trade with a huge profit potential return on it and on zero risk. So that's the other great combination of things you can do. So let's take a look at this example here. So here's SPY. Okay, so this was converted to a long put condor. So the original trade was just a short trade, looking for a downside move down to this Fibonacci level right in here, 270-ish right here. So it was trading right here about 275. We were looking for a move here. So the thing was, okay, if it got down here, let's take a look. Can we convert this to a put condor or butterfly and reduce our risk to zero, or maybe bring in a credit? All right, so the trade we set up was a really low risk trade to begin with. So it was buying the 273 put, selling 270, and that cost $65. So very low defined risk trade to start with. Potential profit if it closed down below the short strike of the put, below 270 at expiration, $235. But what's the problem, man? Every time the markets go down, a lot of times they snap right back up. So with this trade, we were going to say, okay, if it goes back and it hits our target, first thing we're going to do, we can take profit on part of the trade. So it hit down to the first target point at 271 area. So it took $98 per spread profit on that part of the trade. So 150% return, but instead of closing out the whole trade or keeping some on to see if it could close at expiration, we converted this to a condor, recouped our cost of the trade, and then could sit on it without any risk. All right, so here it was, $65, pops down to that. So we're up 98, so that's pretty good return. But then the second part of the trade, when it hit down to that 270 area, instead of closing out the rest of the trade, we sold a bull put credit spread here. Sold the 268 put, bought the 265 when it was trading right there. So we sold that put, bought the put, bull put credit spread, and so that brought in $65 credit. All right, so now we reduced the trade to zero. So the cost of the debit spread was 65. We brought in a credit of 65. So now we're into a trade for zero risk on what we call the long put condor. And now you sit back into expiration and see how it goes. So this is the structure that it created. So we were originally long the put debit spread, sold down to that 270 area, sold a put, bought a put, so bull put credit spread, So $65 on the debit cost, 65 credit, 0 risk. And so the potential profit, if it goes out between the short strikes here, was 300 max profit on 0 risk. It ended up going out here when we closed it out 271.33, but still not bad. So this was out making $167 or $64 per spread on 0 risk. So when you evaluate the trade, you can see how this was enhanced by first, trade 1 made $98 or 150% return, but trade 2 increased the profit 2 times to 164, but on 0 risk. So that's the really great thing as well. So you can do so many, you just got so many different variations that you can do and use. Now, if you'd like to learn more about how to master these strategies that are really high reward, low risk, I've got a fantastic offer for everybody here tonight. So there are 2 things. You could either hopefully you took some good notes and you go back tomorrow and start probably doing some of these maybe on your own, or if you really want to learn it, I've got a fantastic offer for you. So this is my Butterfly Masters Long Condor course that I did a couple months back. And so it's a recorded 6-hour plus, hour course, and broken down in 30-minute modules. And this is just 100% on using the Butterfly and the Long Condor option strategy. I'll show you what all it covers in the course. But not only are you going to get this course, but you're going to get some 8 other bonuses. So you're going to get this right away on demand, recorded, and then it will come with a live follow-up Q&A. So we'll send out a link for that, probably a week, 2 weeks, that'll be recorded, and then you'll get these additional bonuses. So let me give you the link here. I've got 2 packages for you. One is just if you just want this package here, and it's $97. So if you want to learn a fabulous strategy and get into it for very little cost, which is an investment of $97, you'll make that back really fast. And so you're going to get the 6-hour recorded course. This is broken down in modules of 30 minutes or less. The PowerPoint of the course is over 400-page PowerPoint, so my courses are very detailed. And then you're going to get bonus specials. You're going to get, first one is my recorded options for beginners. If you're just starting out, this will be a great course to add to your library. And then you're going to get my other option beginners program. So add that to your library. And then this new, I just did this to provide everybody. We're coming into a lot of probably potential volatility here, going into the end of the year, the elections. So this is a really great hedging tutorial. It's for hedge if you want to hedge a stock or portfolio. This will teach you how to do it in this tutorial using what we call the collar. So that's going to be part of your bonus. That's worth the $97 right here to learn how to hedge a stock portfolio or a stock that you might have. And then you'll get the 1 live follow-up Q&A recorded as well. My option trading tutorial, another option course here. My option strategy manifesto, 15 options, really great strategies here. You can, I'll show you what that is. My Greek power tool guide gives you the Greeks, and you're going to get a trial membership to my trading club for 30 days. You can start that whenever you want. You don't have to start it right away. If you want to start a week, 2 weeks, a month, just send us an email and we'll do that for you. So you're going to get everything here for $97. So excuse my watchdog is starving to death. I'm so mean. All right, so that's package 1, but I've got another great package. If you want my alert service, this alert service is, this will give you all 4 of my trading alert services. This will be breakouts and reversal trades. These are really powerful momentum trades. And these are all, I'll always give you an option trade with the trade breakout. In this example, these are usually debit spreads. And then you're going to get my Butterfly Long Condor setups. When I send those out, calendar diagonals, and earnings trade setups. So you'll get all 4 of these alert services, okay? These are text out or emailed or both, however you want it. Plus, you'll get everything in package 1. So you're going to get all this, all 4 alerts, and then you're going to get my trading club also comes with it for 13 months. So in package 1, you got all the bonuses and you get the alert, you get the trading club for 1 month. Here you get everything in package 1, but all 4 of my trading alert services for 13 months, plus the trading club for 13 months. All right, so again, you get all my alert services, 13 months, typically 10 to 25 or more stocks or ETF trades per month. So these are going to be either breakout reversal type trades, butterflies, condors, calendars, calendar diagonals, and earning trades. So all 4 of those. So a lot of variation there. You'll get a trading guide for each when they come out by text. I do a trade setup video on those after the trade's put on that night. These are all archived and listed. So then with the trading club for 13 months, you get access to my live Q&As every week. Okay, those are live and recorded. Access to my video newsletter every night after the market close. Video of my market perspective, any trades we're looking at. You'll get that every night for 13 months. And then access to my trading room each day during the week for 13 months and discounts on everything on my website for 60% off for 13 months. So it's a really great package here. If you'd like that, I wanted to make it available and just use this link here, and there's a 2-pay for you. So that's it. Now I'll go through all the bonuses here. Then if any questions, please feel free to go. Here's the link here. You should be able to just click on that link, and it'll pull it up, and then you can just there's 2-pay if you want it, but you can see here's for the alert service. You get everything in package 1 plus all 4 of my alert services, PayPal or credit card there. So that's that link. And then if you want just package 1, it's this link here, powercycletrading.com/BExpo butterfly. Here's that link, and you should be able to just click on that one as well right there. Let me make sure it's working good here. Yeah, looks good. Okay, so that's that. Now let's go through everything you'll get, and then if you have any questions, feel free to ask. So here's just the trade summary too. So the first service that I set up was back in 2018. These were breakout and momentum breakouts and reversals. And we've had, here's through today, we've had 132 trades closed out, 99 wins, 4 break-evens, 29 losers, 78%. These are all debit spreads typically, so very low defined risk trades. And then the next service I started was the butterfly long condor. These are very, very selective butterflies and condor trades that I text out. We've had 43 closed, 29 wins, 3 break-even, 11 loss, nice 74% winning percentage. Now these are very low defined risk trades, typically $50 at risk to maybe 80 or 90. But with the butterfly condor, as you see, you get a huge potential risk reward payoff 2 to 1, 4 to 1. So these are really great trades. So you get a variety of different trades that I'll text out depending on what the market's looking like. And so then we've been doing a lot of calendar and calendar diagonals, which are also selling strategies. And we've had great success, 46 closed, 38 wins, 1 break even, 7 losses, 85% win percentage. And then the earnings trades are, these are kind of directional, non-directional earnings trades that we do. And these are, have been really high winning percentage, 40 wins, 32 winning trades, break even, 1, 7 losers, 82% there. All right, so let's go through. With the butterfly course, 6+ hour course, broken down 30-minute modules, you get the 437-page training manual, which is my PowerPoint. The courses are taught with a lot of different trading examples, so you can kind of follow along and see how it works. So this is a really blueprint course on using the butterflies and condors. So for income, high reward, low risk directional trades, non-directional hedging, very, very expensive, thorough course. So we start out part 1 of the course, going through the Greeks that are vital that you understand, how they affect the butterfly long condor, theta decay, its impact, how it's used to benefit the butterfly long condor, volatility, the importance of that for the butterfly. So you're going to learn about the basics that you need to understand about the option side of things here in this course as well, and then how option pricing works. So its effect on the butterfly by taking advantage of that time and volatility collapse, and then using standard deviation. So we use standard deviation. It sounds intimidating, but it's just for forecasting the price targets that we use. And so it's real simple, and I'd take you through the course on how to do that. And then the core basics. Most traders just they miss it. They don't understand, man, the butterfly and condor have so many fantastic advantages. So go through those basics and why it really provides you some great advantages. And then I go through each different variation of the butterfly. The foundation of them is the vertical spread. So I go then through how, why, when to use either a long call or put butterfly a wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So course takes you through each variation of how, why, and when would you use those with examples. So what are the best time frames to capitalize? Do you go out, 1, 2 days out, 2 weeks, 3 weeks? So go through that. What to use? Stocks, ETFs, which ones are the best? How do you get those 10 to 1 or higher returns? So go through the structure in a lot of great detail. How do you profit from that volatility collapse, theta decay? So you'll understand that once you complete the course. And then in the course, I also cover monthly option expiration, what we call those pinning trades, and how then to do this 12 times a year. So we have monthly expiration 12 times, right? And so this is a really fun thing to do. So option pinning, so it gives you a different stream of income. And then how do you select your targets? So I go through in this course to teach you how to set your targets for the pin based on option activity and Fibonacci levels. So you learn that. And then we get into the long condor, which is, the major trading advantages of the long condor. And that's by, again, combining the vertical spreads, debit with vertical credit spreads. And these are a fantastic strategy for high reward, low risk. And this is one of the favorite kind of go-to first strategies for hedging. All right. So then in the course, go through the step-by-step checklist of when to put the trade on, take it off, execution, trade management, and then a big part of the course is spent on hedging. Okay, so this is a big, big part of the course. How to use the butterfly or long condor hedge to hedge a core position, and also how to use these two strategies to defend if you do vertical debit spreads or credit spreads. So this alone right there is worth the value of the course 10 times. And then you get a resource library, what is assignment risk, expiration risk, auto exercise, and then it comes with the trading library of 58 trades. Hold on 1 second, please. I'm sorry about this. Hold on 1 second. Sorry about that. All right, so then it comes with the trading library. I like to go give a lot of examples because, a lot of times that's a great way to learn a trade is just to look at past trades. And then that's kind of the basics of the course. So it's a very extensive, great course. Here's a little feedback. So this was from Pam. Excellent class, Larry, as usual. You under promise, over deliver. Wish I'd known how to use this hedging before I lost so much money doing credit spreads. That's such a great example. So many people lose a lot of money on credit spreads. So this will teach you how to defend those trades. And then from Jim, thanks again for showing so many ways of getting out of trouble, right? So you get in trouble. These are some trading strategies you can use to help you get out of trouble. So it could have come in handy in the past, and my trading P&L would have been totally different. Here's from Dan. Besides being profitable, you can tell your audience that your courses are right on point and you're an expert among experts. Using your alert service was instrumental in me learning more about options as well. So here are your bonuses. Okay, so I call this my survival bonus package for you. You'll get first, my options beginners course is a brand new course. So add this to your library. If you're just starting out, it'll be a great course for you as well. Now, all this stuff is yours forever. You'll get a login, and then all the courses will be on the cloud. You can print out the PowerPoint, and then the videos, and it's yours forever. Okay, so you'll get all that in a login. If you ever lose it, you'll just contact us. We'll give you a new login. So this one covers the benefits of options versus stocks. So insider trading tips that you need to know, must know option basics, mastering puts versus calls, option expiration, how that works. And then I give you in this course 2 really good starting strategies, covered calls, and then the income protected put strategy, and then resources. So you'll get that. Then you'll get my options beginner's home study package, another really nice kind of 4-hour course, comprehensive, easy to understand training course to get you started on options. Okay. So it goes through developing a trading plan, basics of options, how options work, types of options, monthly, weekly leaps, option accounts, etc. So you'll get that as a nice bonus. And then this is something I just put together, which is a really great tutorial on hedging stocks or portfolio. So to get you prepared for managing your trading risk of a portfolio, let's say you have a stock portfolio of $1 million or $2 million, whatever this will teach you how to hedge that portfolio if you like. So this will be an 18-page portfolio hedging guide with video on how to step you through to, figure out how many options you need, et cetera, to hedge a stock or portfolio using the protective collar option strategy. All right, so great tutorial for you to have. So that's going to be thrown in as a bonus as well. And then live follow-up Q&A. We'll send you a link on that. It'll be a week or 2 weeks, and then it will be recorded as well. And then you get another option guide, my tutorial, 60-page option tutorial with the Greeks. This covers all the Greeks, delta, gamma, theta, how option pricing works, standard deviation, option delta, trade probabilities, and then my 15 option strategies this will take you through a guide to show you how these are constructed and when to use like a ratio, back ratio spread, the straddle, so just an additional option information for you to put in your library, and my option Greeks. Okay, so this is something you can print out, put on your desk, tells you what delta, theta, gamma is. So right there is a reference. And then 1 month trial membership to the trading club. So you'll get access to my trading room every day, Q&As every week, etc. Here's some feedback. Said, Larry, wanted to thank you so much. I'm glad I found your service. I'm learning so much. Thanks, Richard. Just wanted to say my option knowledge has leaped exponentially since joining your trading room. So Jay says, reading books is fine, but seeing the actual option trade setups makes a huge difference. Thanks, Jay. So Jay started out in a package like this, free trial membership. Now he's an alert member for a year, 2 years now. And then KG's been with me for a long time. And so with the trading club, you'll get access to my virtual trading room each day during the week. And for the open and the close, I send out a daily market video newsletter every day after the close, kind of going through the markets, what trades we're looking at, trades that we were setting up. And these are all archived. And then we do a live Q&A every Tuesday that's also recorded. You get an good educational material on the website, and discounts of 60% off on all courses and software on my website. So you get all that. And so that will be for 30-day trial membership, and you can start whenever you want. But if you do the alert service for 13 months, you get all this for 13 months. And the alert service, you can also start, when you want. You don't start it right away. So just let us know email-wise. So here's some trades here. I want to go through the alert service, just show you a few examples here. And here's Jay again. He started out with just the trading club. He said, I'm loving my subscription to the trade club and the alert services. I paid for it in the first week. I guess now I'm a scholarship student. It's a great start and finish to the market day with Larry. Put on the trades, not be glued to the screen all day. Do real life stuff. Check in a time or two and be there for the close. I'm retired. The market's my main hobby, and this is exactly what I've been looking for. I'm learning like a sponge every day. Kind regards, Jay. So, a lot of my members are retired, but in trading is their hobby, but they're, doing really well. They love trading, and so it's a lot of fun. Better than being out on the golf course. And then here was Dan. He said, the alerts work. Larry's done his homework. I paid for the alerts with my first 4 trades. And this is kind of interesting. He said, actually, I wasn't trying to make money. I was just trying to learn how options work. The wins with the alerts gave me great confidence to continue learning about trading options. All right, so here are the alert service summary. So you'll get any alert that I send out. You'll get a suggested option trade. So a lot of members kind of do their own thing, but I always give an option trade if you want to take it. And so with that suggested option trade, you'll get your entry level, target levels based on option activity and fib levels, what option series to use, stop loss levels, and then all these trades are listed and archived for you. So you'll get a setup video of that trade after it's done that day. You'll see that in the newsletter that night with the video newsletter. So each night after the close, you'll get access to my weekly Q&A every week during the week for 13 months, access to the virtual trading room every day during the week for 13 months. So the trading room's open from 9:30 to 10:30 in the morning. I'm the one in there, and then back for the close, and then 60% discounts on all courses and software on the site. So all that for 13 months. Yeah, and here's the link again for the alert service, Charles. Hold on. Use this link here. Okay, there you go. And yeah, and then just for package one here, that one is again as well. So I'll show you some of the recent alerts here that were sent out. These are all text or email. As soon as I put them in, they're out in about 2 minutes or less. So this was a Netflix breakout trade that we did, back on October 1st. So you can see here's what it looks like. Here's the text that you would receive. It says Netflix long trade, trading at $4.95. Buy to open the vertical Netflix 9 October, $4.97.5, 500 call, debit spread at $1.10, give or take. Stop loss 60% debit, price target 1, 504, target 2, 508. All right, so that was sent out on the 29th. And then targets were starting to be hit on the 1st. So then I sent out if there's an adjustment or profit take or stop, I'll text that out. So this was texting out that it was hitting through our profit targets. So if you want to start taking profit. So this was from KG. It was one of the first ones to sign up a couple of years back on the alert service package. Well worth it for all the trades from Larry for a year on my cell phone. I made more than the 1,200 on my first trade. Larry suggested great price traders, worth the investment. So here's the next Netflix trade set up here. Beautiful breakout trade. So put that on with the debit spread and just exploded. So we had multiple target points. This was a max profit trade. So it was done with a defined risk debit spread of $1.05 and max profit of 145 because this one blew and closed max profit at expiration. So really nice trade there. And then here was NVIDIA trade set up September 28th and then out pretty much almost the next day. These are very, very big breakout trades, so they happen fast. So here's the Netflix NVIDIA. Long trade at 515, buy to open a vertical debit spread. Here another debit spread. The debit spread costs $1.10 or less. Stop loss level, profit targets, and then here's the exits I sent out that same day. We started hitting profit target 1. The next day profit target 2, and then so on. So this was NVIDIA breakout trade to the upside based on my trading model, and then the option trade here was doing a called debit spread of 515, 17.5, $1.10, and now for max profit 140. Here's an example of the butterflies. This was that QQQ short butterfly trade setup I showed you earlier, and so this was doing it as a put butterfly. All right, so that was the short trade. That was a text alert. Here's the GLD butterfly. That was a text alert, and so these are all examples. Here's a calendar trade diagonal trade alert. This was a fantastic one we did just last few days, about a week back. This was on Microsoft. Beautiful breakout trade, but we did this with a calendar diagonal and then adjusted it to call debit spread, had a huge profit on that. So trade 1, this was on the 25th, set up at 495, and then on the 1st, it was trading up to 650. So at that point, it was up $155 per spread, but then we did an adjustment on it to convert it to a call debit spread on the 8th of October, and this went out max profit about a week back at $536 per spread. All right, so that's an adjustment on a calendar that we started with, and then earnings trades. Here's a double calendar example that we did on Microsoft last cycle, earnings cycle. So it goes through very defined how to do the trade if you want to do it, when to put it on, take it off. And so here was where it was trading, and we did this as what we call a double calendar. So pretty cool trade. And so this was on the next day, $35 profit, and then it went out at expiration right here at $67 per spread. And then so that's basically it. So you get all that and all those great bonuses. So hopefully you'll take advantage of it, and I'll love to take any questions you have, or look forward to working with everybody in the future. Yeah, so you can start the trading room, the trading club part whenever you want. You don't have to start it right away. Whenever you feel comfortable enough that you want to start using your time. All right. So if you get either package, if you do package one, you get the 30-day trial membership to the trading club. So you can start that when you want. You don't have to start it today when you buy the course, buy this package. Just send us an email and we'll start it when you want to start it. So here's the email: support@powercycletrading.com. Okay. .com. Okay. So you can do that for your 30-day trial if you do package one, or if you do the alert service, you can start the alerts whenever you want. So you don't have to start right away. So whenever you get comfortable and you feel you're ready to go, then you can start your time. So if you want to start your time next month, that's fine. Just send us an email and then we will start you in November or whatever, your 13-month time. Okay. So good question there. Yeah, well, yeah, with the butterflies, I mean, this course is, it's yours. So it's broken down in modules. So it's a lot in the course to learn. So you'll get this, the recordings are broken in modules like a chapter of a book. So you can go back to whatever part of the course that you need work on, right? So, and it's yours forever. So it's a great way. I mean, for 97 bucks, you should, if you want to be serious about your trading and being successful, this is a great place or great way for you to get into it, because not only do you get a fantastic butterfly condor course, but you're going to get my options for beginners, beginner option program, this hedging tutorial, which is great if you've got a stock portfolio. It'll teach you how to hedge it. And then my option trading tutorial. So you're just going to get a lot of great stuff, content here just for that small price. Yeah, so if you do the first 30 days as a free trial, and then if you want to stay with our trading club, it's $97 a month, or you can do an annual membership for $488. All right, so whichever one, most people will do, go to the annual membership of $488. So yeah, so $97 there, and then if you want the alert service, you get everything in course package one, all the bonuses, everything. But then you'll also get the 4 trading alert services, or text out or emailed or both, however you want it. And you'll get that for 13 months plus the trading club for 13 months. So access to the trading room, Q&As, all that. And again, you can start this when you want. Just let us know. Now, 488 is if you go from your $97 per month membership, which gives you the trading room, the trading Q&As, the video newsletter. If you go 488, then it's a huge discount. You get all that. So let me back up. I'll show you. So with the trading club, this is what you'll get for the alert service package for 13 months. You'll get this is the trading club, what you get. Hold on. All right. So with the trading club, so package one, you'll get this for 30 days for free. So I have a virtual trading room. I'm in there each morning for the open, 9:30 to 10:30 Eastern, and then back for the close. So go through, if you have a trading question on any kind of trade you're doing or any setups that we're doing, we'll cover it in the trading room. All right, so it's a virtual trading room. So you'll have access to that. And then I do a Q&A every Tuesday, live and recorded. So you have access to that each week. And then these are all archived. The Q&As are recorded and archived. And then you get my educational access to that. And then you get my trading, my video newsletter every night after the close, daily market trading update videos. So you get that. So you'll get that for every day during the week for 30 days. And then if you want to stay on, it's $97 a month, or you could go to an annual membership. What is the difference between 488 and 1,000? The 1,000, you get the alert service for 13 months and the trading club for 13 months. All right, so it's different. If you just want the annual membership, if you want this $97 a month membership where you get the trading room, the Q&As every Tuesday, the video newsletter, etc. It's $97 a month. Or if you want to get it for $488 annually, you can do that. So it's about $70. But if you want the better service, which would be the alert service, you're going to get all that plus my text alerts, 4 text alert services, breakout reversal trades, butterflies, condors, calendar diagonals, and any earnings trades. So you get all 4 of those, plus the trading club comes with it for 13 months. So you get the trading room every day, you get the video newsletter every day, the Q&As every week, etc. So everything I showed you just a minute ago in the trading club, that comes with this package here, but you get it for 13 months along with the 4 alert services, plus everything in package 1, the course and all the bonuses. So, huge difference. Much better to do that than the $488 annual membership, but that's what's being offered here tonight if you're interested. Did that answer your question, Alan? Okay. So here's the link again. If anybody would like to still put in order, just if you don't mind, put in number 1 and I'll hang around. If not, we'll call it an evening. So here's the package 1. And if you want the alert service, here's that package, and that's this link here. So anybody still looking at placing an order in the process, if you don't mind, just put it in number 1. I'll make sure I stay until your order's in. And or if not, we can call it an evening. So I appreciate everybody being here. Yeah, so take your time. Yeah, I posted the watch list. You should have gotten that yesterday. So how much capital is needed for these trades? Well, if you look here at what you get, here's the, you can kind of figure it out. So for example, hold on just a second. So typically, well, let me just show you some examples. So here's the capital you would need. So for this Netflix trade, it was $105. Okay, so if you did 1 contract, you need $100. Now that's, so if you did 10 contracts, you need 1,000. So it's going to depend on your brokerage count, but that's not a lot of capital, really, $100 per spread. If you do a butterfly, if you take a butterfly alert, it could be as little as here, $30, right? So $30 per spread. So very low capital. If you do a calendar, here's the calendar. Now this was another butterfly. This was $90. Okay, so if you did 10, that's $900. If you did a calendar diagonal, these trades are going to be a little bit more expensive, but these are very low risk trades as far as the probability of these winning. So this was trading capital, and this costs $495 per spread. Okay, so that you can get an idea of your trading capital. You don't need a lot of capital to do this. So this was set up for $495, and after the adjustment, ended up making $536 profit, on that spread. All right, so yeah, so take your time there, Theodore, sorry. Yeah, the breakout trades these are swing trades. Yeah, we use weekly options. So if you look at these swing trades, they're weekly options. So here's the backing up to that. So here's NVIDIA. So this was setup was the 28th. We used the 2 October weekly. Okay. Netflix right here. This was the 9 October. These were weeklies. These trades are typically anywhere from 4 days to 2 weeks max usually. These are breakout trades, so they're momentum, so they're pretty fast. You can just see this Netflix. See here? Here's where the Netflix trade was set up and just exploded to the upside. So that's what we're looking for. So that's why I have 4 different services. These are really explosive type breakouts, etc. How do you set the trades? Well, I give a breakout trade entry right here. Okay, so this is my trading model, and I talk about this in the trading room. We spend a lot of time. We'll talk about these trades, and then I'll send it out by alert. Now you can see here's the alert text. All right, so when this was sent out, it tells you it's trading at 495. So it's trading right here, and then it tells you what some of the members might do their own thing. They might just buy the calls, but I'll always give you a lower risk spread, option spread. So here it says breakout at 495. So some members might just go ahead and just buy calls at 495, whatever option series they want. But then I will give you a specific trade. So in this one, it says buy the 9 October 497.5 500 call spread or debit spread at $1.10, give or take. Stop loss level 60% of the debit paid. Price target 1 504 2 508, and then boom, this one just went. NVIDIA the same way. Trading at 515. Some members might just buy the calls right there, or I give you a specific trade. Okay. And that's, yeah, so yeah, any other questions? I appreciate everybody being here. Anybody else that wants in, just put a number 1 in, take your time, and I'll confirm that you're in. So anybody else needing to order, let me know. And let me just double check your order, Theodis, see if it went through. Hold on a second. 1 second here. I don't see it yet. Let's see, hold on. Is it Theo? Yeah, not seeing your order go through. Just let me know once you put it in. I'll confirm that you're in or not. Okay, so yeah, take your time, Nora. And Theo, I'm not seeing your order in there yet. Check again. You might try it again. If the order goes in, sometimes you might have to click on it again. If it goes in twice, we'll just we refund you right away. Having a hard time getting in? Well, just use this link. Just pull up a browser, okay, whatever browser, and then just copy and paste. You can put in which package do you want, package 1 or 2. Just type this in powercycletrading.com/BEXPO. So you should be able to click that link, and if that's not working, then just pull up a browser and just type that in. I'll show you. So it's usually pilot error. It's usually your fingers mess something up, Yeah, of course, it's on everything. So if you sign up tonight, you get 60% discount. And I'll show you everything. You'll get courses on everything I have at a 60% discount. So if you want to type in that link, just pull up a browser. Okay, so pull up whatever you use, Firefox, Google, Chrome, whatever, and then just type in, all you have to do is type in powercycletrading.com/BEXPO, all small cap. Click enter, And boom, there she is. So you should be able to just to click on that, or you can copy and paste it, or just type it in. And yes, question, do I have, I just completed a course on breakouts with all my trading indicators. I've got all 7, my trading indicators were offered in the course. So let me show you that. So as a member, if you sign up tonight, you'll get a discount on everything on my website. So here's all the different stuff that you'll be able to get your hands on at 60% off the retail or off this course prices on the course. So here, if you go to powercycletrading.com courses, if you just come here, you'll see the butterfly course that you're getting here tonight for $97. It's offered here at right here. Here's that butterfly course. You're going to get that tonight for $97 plus all the bonuses on here. If you go to the site, this $397. Now, if you were to buy it as a member, you get even 60% off that. But if you buy this course tonight, you're going to get it for $97 plus all the bonuses. Now, if you want my breakout course, go here, boot camp coaching here. And I just completed this course about a week ago. This was our, right here. Where was that? How to swing trade and day trade breakouts and reversals, okay? This was just completed. It should have changed. I just finished, this was a new course I just did in August. I don't know what's showing May. Anyway, so you'll get that course here. You can get, that comes with all my indicators, and you'll get, if you want to buy that, it's a fantastic course. You just put in, this comes with all my 7 indicators. You just put in here, and you put in your, you'll get a membership code for 60% off, and you just plug that in, you get all that off for 60% off. That gives you all the indicators. The course here, if you just want the course, is $397. So you get all that, and here's my trading software. If you ever want any of my trading tools, as a member, you'll get everything here that's listed at 60% off of any of those trading tools. And we have these for Thinkorswim, TradeStation, Ninja, eSignal, etc. Okay. All right, so let's see here. So try again there, Theo, and then I'll confirm. John, I see your order. John, yeah, your order came through. All right. Okay, well, again, thanks. Theo, are you still trying, or are you giving up? Okay, did you get it in? Just let me know. And if you need some help, I can have my assistant contact you. So if you want to try one more time, or if you're still having trouble, we can get a hold of you. I'll get your email, and we'll get back with you on that. So would you rather do it that way, or do you want to try it one more time, Theo? Lewis, see your order just went through. Charles, you're in. Lil, you're in. David, Thomas, you're in. Sam, Theo, I'm not seeing yours yet. Thomas, yours is in. I just see yours came through. Yeah, you don't do it on the site. You don't go to the site. You're not going to be able to get this package on the site. You have to use this link here, powercycletrading.com/BEXPO. You can't get this on the site, so you just don't go to the site. Now, once you sign up for this package, you'll be a trading club member for 30 days, and during that 30-day period, even if you don't stay on, you can use your discount code of 60 for anything on the site. So don't go to the site. Just use that link there. You can't use that on the site. That won't get you anywhere. Okay, so just use that link, and then once you get your membership code, then you can go to the site and pick out anything you'd like, and you'll get it. But this package is not on the site, so you have to use that link. So you can just, again, you should be able to just click on that, or if you are having trouble, just pull up a browser again and copy it or type it in. So you could just put in Power Cycle Trading, type in powercycletrading.com/BEXPO. So it's pretty simple here. So just however it works, just type in powercycletrading.com/BEXPO, click enter, and that'll pull it up. That's what you'll get. Okay. All right. So all right, any other questions, or if anybody else is still trying to get in, let me know. Otherwise, I really appreciate everybody being here tonight, and looking forward to working with you in the future. So thanks again. Does not respond. Not sure I understand. Okay, so just click the link. And if you need help, you can just, send us an email. We'll be happy to help you out. Okay, so if you need some help or something for some reason you can't get through, just send us an email. We'll take care of you that way as well if you need help. Okay, Theo, are you done or no? Otherwise, we'll take it up another time. All right, well, thank you, everybody. Have a great rest of your evening. Again, if you're having trouble with an order or something and you do need just additional help. Okay, so you need help. Does that mean that you need us to put your order through? If you need help, then send us an email at support@powercycletrading.com, and we will get a hold of you to help you. Let me see, I can even copy your email address here. Okay. So Theo, I'm going to do that with you as well, and I'm going to do that with you, members. Theo, so you want package one, so just go here, powercycletrading.com/BEXPO, or just use this link here. I'm going to put it in again, and then just click on it. Click on this link here. See the link there? If you just hover over it and click it, it'll open up a payment link, or just open any browser and then type in that powercycletrading.com/BEXPO. So you can do it that way, or if you're still having trouble, then we can help you. Just send us an email, and I've got your email address. We can follow up on that as well. All right. Let's see here. Theo, did you get yours in? I'm going to check one more time. All right. Doesn't look like it went through. All right. So we'll get a hold of you. And if you need some help, we'd be happy to help you. All right. Thanks, everybody. Have a great rest of your evening. Good luck trading tomorrow as well. Ciao.